Hi, good morning. Thank you for coming to hear our presentation. We are the technology sector. My name is John Peter Desmond, and I'm a junior majoring in mechanical engineering.
My name is Alondra Villarreal, and I'm a finance major.
My name is Matthew Michaels, and I'm accounting and finance.
Okay, so the objective today for the tech sector was to analyze our currently owned portfolio and try to add some value by doing some relative valuation, absolute, and just conducting research to pitch a stock that we would like to add from the technology industry to the portfolio. So an outline of the methodology that we did for this was basically look at tech sector breakdown and then look at the profitability and risk metrics within the sector and then find a valuation metric to compare against those and then develop the ranking model. And the tech sector breakdown by sub-industry would be the software, the tech hardware, the IT, data processing, communications, semiconductors, and IT software services. So yes. So then this is our model. So a little bit more on the methodology for it, a little bit more detail would be the company analysis. So we went through and found those companies after we got to the Russell 3000. So we took the Russell 3000 index, broke it down by sector, took the tech sector out, threw it in Excel, and broke it down by sub-industry, and then threw in all our risk and profitability metrics and compared them to the equity valuation metric. And we got a correlation with the metrics that we chose, and we used that to give us our short list and our buy list, and then we created rich for cheap stocks to just show us more visuals of how our model is comparing our currently owned stocks and our buy list to the market. So these are the fundamentals that we used. We used research and development expenditure to net sales, and then 3-year average growth, EBITDA margin, the best estimated long-term growth, and the Bloomberg 5-year default probability. And these we got through extensive research and a lot of trial and error, just looking at Bloomberg Industries to see what the tech sector analysts are using and watching a lot of news and watching videos online to see what is trending within the tech, to see what right now the industry is caring about. So we saw that right now that the industry cared a lot about sales and the long-term growth as well as the EBITDA margin, with not wanting your company to default within the next 5 years and making sure that your company is not just spending a ton of money on R&D since they're tech and going to default soon. And then we compared it to the EV to sales, and then here's our model value. So this are the buy list that we got from our model. So after we put all these profitability and risk metrics up, then we put them against the EV to 12-month sales, and we ranked them, and we used Solver to rank these with weightings and see which one our model cared about the most, which ended up being the EBITDA margin, and we weighted them and then re-ranked them to not just say that, okay, average this has the highest, but to actually like put them against each other using the sum product and get a re-rank. And then this would say like, okay, overall, these are the top companies. And then right here, we ranked the EV to sales. So then within this re-ranking compared to the EV to sales, we cared a lot about the difference that it was. And this was an analysis that we did within our buy to see which one had the highest difference, not just solely choosing, okay, our model chose the stock as number 1 ranked, but the difference between this and the market value was only 53. So when compared to a stock that's ranked over here, 18 to 137, that 119 difference shows that our model is giving us a lot better undervaluation compared to the market. So we care more about this stock than we would at number 1 to 54. So we actually used that approach to help us. We did subjective research after we got our buy list to create our short list, and then just a view of what stocks our portfolio currently has in it within the tech sector. And then here are Z-Links and Google, which our model gave us as buy, but we also own these stocks. So then that was kind of nice to know that our model gave us Google as a buy, because you'd kind of expect it to be. And then we got our short list after looking at the differences and choosing from our buy list and each breaking up the buy and then doing subjective research to see which ones we'd like to proceed with. And from there, we got our short list, and to help us get our correlation, we broke down we created the cheap versus expensive stock for the entire industry. So here's a view of all the buy list and our entire portfolio earnings, and we got a correlation of 77%. But it took a lot of trial and error to get this correlation, as well as trying to figure out where within the tech sector was an issue because the correlation was lower previously. So we broke it down by sub-industry. So we took out all of the software companies within the tech sector and then analyzed those individually and looked at what the correlation we would get for that sub-industry. So trying to figure out where our model was being negatively affected by what sub-industry. So software was 60, so that kind of had a negative impact. Electronic equipment was doing good with that 92%, and then media had a 54%, and our model didn't pick any buys, and we don't own any media companies, but this was still chosen as a sub-industry within the technology sector from the Russell 3000. So it was in our model, but due to this bad correlation, we decided to remove the media companies to the final correlation of our model. And we also, what else we broke down was the tech hardware, the communications, the IT services, the semiconductors. And the semiconductors is what our model has a lot of in our buy list, and we actually ended up choosing the semiconductor. So then here's just an outline of another outline that I mentioned earlier of our current portfolio holdings broken down by sub-industry. So then we came down to our buy list, and it was composed of 43% software, 43% semiconductors, and then 12% communications. And highlighted red is our short list. So we ended up getting Facebook, Xperi, and then Monolithic Power Systems from our short list after we analyzed this buy list a lot more extensively, and then we came to this selection.
So for our top picks and selection, we chose Xperi Corp. So Xperi Corporation creates, develops, and licenses audio, computational imaging, computer vision, semiconductor packaging, and interconnect technologies. So this company offers many products and solutions to mobile, home, data center, and automotive industries. So a little background of this company: current CEO is John Krishner. It was founded in 1990. It is a small cap stock with market cap of 1.22 billion. Its revenue from 2017-2018 has increased by 8.67%, from 328 million to 406 million. And it is growing with patents right now, so it has over 5,500 patents and patent applications worldwide. It has gone through 28 years of innovation, and we know that that is a very important factor in the technology industry, since we do know that this is a rapidly evolving industry, and companies do have to keep having a competitive advantage and adapt. They have over 700 employees worldwide, and many of its main customers include well-known companies that are top players in their industry, such as Sony, Nvidia, Intel, LG, Samsung, and some automotive companies as well, like Audi, Hyundai, amongst many others as well. So to give a little deeper history of this company, Xperi was founded by IBM research scientists in 1990. And then it became Tessera Holding Corporation. From then on, all the way up to 2017, when it became Xperi. And throughout that time period, it did work with several companies overseas in Japan and South Korea, and also in the US, working with licensing, so Hitachi, Shinko, and Samsung. It then did some acquisitions to basically, like I mentioned, keep their competitive advantage within this industry. And also, since this company has a lot of patents, they did face some problems with lawsuits that they wanted to pursue. So they did go against Motorola and Qualcomm and did win those rulings, and then kept on making some acquisitions to further their technology and evolve with this industry. So we decided to make a Porter's 5 Forces on this industry and sector, kind of analysis of both of them combined. So the cost for threat of new entrants, the cost of capital of this industry, this sector is pretty high. So it's very less likely for a company to start a business in this industry. So for power suppliers, there is a large number of suppliers that don't allow their buyers to negotiate their prices. So for this, the power is low for suppliers. And for buyers, the economic moat for semiconductor manufacturers is low, considering that many of their customers are manufacturers. So the manufacturers are the ones that give the end product to their customers, so this gives them moderately high power for buyers. And for threat of substitution, we decided to analyze this as moderate because this industry is very concentrated, so the product in this sector are very similar to those of their competitors. So there are many competitors out there that also offer these products and services. So for that, in threat of competition, we decided to also say it's high because due to such a concentrated industry, there has to be a lot of R&D made so that they can stay above the technology curve and keep advancing with that and keeping up with trends as well. So as for the products that Xperi offers, we wanted to give you guys kind of like an insight. So they provide two products within two categories that we separated them into. So one is product licensing and the other one is IP semiconductor licensing. So they do have 4 subsidiaries within product licensing that includes Destined to Sound, so DTS, IMAX Enhance, Phonation, and HD Radio. So they work with audio, image, computer technology solutions and radio broadcasting as well. And then also with IP and semiconductor licensing, they do have 2 subsidiaries, so Invensys and Tessera. So one of them works with semiconductor intellectual packaging and property solutions, technology solutions, and the other one is intellectual property licensing. So given that they're very diverse in what they do offer for their customers, we decided to also analyze the revenues by segment and geography. We thought it'd be pretty cool to kind of analyze where the revenues are coming from. So as far as by segment, from the 2 previous categories that I just mentioned, they're relatively close to 46% and 54% for both of them. So they pretty much they bring about the same revenue. So for revenue by geography, the 3 top players were 3 top customers were Korea, Japan, and the US with 51, 22, and 13%. They do have other customers worldwide in Europe and Middle East and Taiwan and other countries as well. And as far, due to the fact that I had previously mentioned that technology is an industry that is rapidly evolving, we always see it when it comes to these new technologies. We probably haven't seen we haven't seen a phone with facial recognition in the past like 5 years or 10 years. So it evolves a lot. So with this being said, Xperi did notice and did state that they will have to be spending more on R&D this upcoming year because they do want to focus on higher technologies and remain competitive within their industry. So they do plan on spending more to research and develop audio image, chip scale, multi-chip, wafer level packaging, circuitry, 3D, water, die bonding technologies, and machine learning. So as far as their strategic vision, they also want to move into smarter technology. So given, we hear about Google and Amazon coming up with the newest products of like Amazon Alexa for home entertainment, they also want to move into smarter appliances, intelligent speakers, things around the house, also into the automotive industry. We are seeing a trend of driverless vehicles now coming along, and also driver monitoring, so telematics. So they are getting involved with that trend as well, that industry, with a lot of different products. And also within entertainment and computing, we've seen a trend within these past years of AI, so advanced imaging. And then so within this category, they want to focus on virtual reality and augmented reality. And then they also want to do machine learning. So we thought that this was a pretty good indicator of pitching this stock since they are moving towards bigger trends now in technology. So as far as the risks go, they do face 2 types of risks, unsystematic and systematic. So for unsystematic, they are involved in a highly cyclical industry, which means that in economic prosperity, the business does well, and in downturn, they don't. And also, their dependence on a small number of customers would be a risk factor in this situation, since they aren't the ones that are providing the end product to customers directly. They are providing to manufacturers that provide that product. So let's say Samsung would terminate their contract with them, they would be facing some risk. And contract manufacturing, we do know that within contracts they do have an expiration date, so if they don't maintain their relationships and satisfy their customers, those customers, since it's a highly concentrated industry, they can't go to another supplier, so that is also a risk. And indebtedness, if they do an acquisition and don't fulfill their goals that they want to fulfill, and go negative and are not able to repay their debts, they will go into loss, and they will also face interest rate risk. And as far as systematic, there can be changes in legislation, so US laws, patent laws, regulations, rules, since this business is heavily invested in patents as well, so that can harm them. And economic conditions can be a great risk factor as well under systematic risk. And next will be multiple market footprints.
All right, guys. So this is kind of an overview of the multiple market footprints. So there's probably a lot of brands on there that we recognize. Xperi has their foot in a lot of different markets. All right, and then we have potential M&A growth, so future endeavors. The first one I'd like to point out is PhotoNation and Tendenzo. It's doing in-cabin monitoring, which is basically making the experience for the driver a lot safer. So if you were to fall asleep at the wheel, it would recognize that, pick it up, and hopefully fix the situation before an accident happened. Then we're doing Xperi to LG. It's connecting radio to IP contacts, so basically the experience that we have on our smartphone, it's going to tie that to our vehicle. And then DTS to CJ4D Plex, we have pairs 3D surround sound with 270 degree visual technologies. So that's a DTS. It's going in basically, it's improving the sound quality that you're experiencing already with a great company that's offering 270 degree theatrical experience. And then Xperi to Pilot, that one's going to be advanced broadcast technologies and cultivate new media opportunities. And then just remember that it's DTS, PhotoNation, Investis, and Tessera. So when we're looking at Xperi, we're also looking at all these subsidiaries. And then this is a chart that's representing the growth that we see in the IT sector. So it's definitely growing really fast, really rapidly. This dates back to 2015, so 2020 is expected to only improve. All right, so these are the financials. I ran a lot of ratios based off what I've learned in my accounting classes and then what I'm learning in my intermediate corporate finance classes. So I believe they help us understand the capital structure of the business. So my goal here is to not take on any more risk than necessary. Why do that, right? And my observations, funds that have recently underperformed are more likely to outperform the market. So up until December, when we saw that huge dip in the market, Xperi was really underperforming. Ever since then, it's been slowly on the rise. I know Cliff Asness says buy momentum. I feel like we're going to be seeing a lot of momentum, and that's just my observation right now. So this is a very volatile market. Semiconductors altogether are very volatile. So we have to look at that and weigh in our judgment. But in terms of financials, the first one I did was for leverage. It was the debt to equity ratio. A high debt to equity ratio generally means that a company has been aggressive in financing its growth with debt. This can result in volatile earnings, but Xperi is on the low end, ranking lower than 78% of globally traded companies. So we saw 0.78. And then also I did liquidity. So I used the current ratio. I did not use the asset test ratio because Xperi currently holds no inventory. So that's all with its subsidiaries and manufacturing licensing. So the current ratio indicates the company may not be efficiently using its current assets or short-term financing facilities. It could indicate a problem in working capital management. Xperi has a high current ratio, indicating that it does not face a risk towards paying its liabilities. So, and we're going to tie all the ratios in at the end too. And then our operating ratio, our asset turnover ratio, funds with low turnover outperform funds with high turnover. This is a low asset turnover ratio and could potentially mean that the company is not utilizing its assets to best generate sales. And then I also did the gross profit margin. This was higher than 100% of the 843 companies that are globally traded in its industry. This gives the company a competitive advantage. It also makes the company very marketable when making investment decisions. And then I also did the return on equity. So the return on equity was 57.1%. Now this was still low, but it was the highest that Xperi has seen in the last 13 years. And that could relate to the growth that we're probably going to see this year, and it's bouncing back off of that dip in the stock, I believe. So then, basically, I tied the debt to equity, I assumed it was low, the current ratio was high, the asset turnover was low. So with the debt to equity, I assumed it's not utilizing growth on assets. And then with the current ratio, I put low risk to paying debt, so it doesn't have a lot of debt, and we can see that with the gross profit margin as well. And then also it's asset turnover. It explains the current ratio and asset utilization. So, and the ROE rising still low, soon to be momentum. And then the beta risk, so for the market, the beta risk is forecasted to be over 1, and we saw 1.05, so this definitely falls true to the forecast. And then our market to book ratio, so the price per share divided by the book value per share, we got 1.95. Anything below 1 would be risky, but we're seeing 1.95, so this is hopefully, potentially, an extremely undervalued stock. And then our dividends per share were 20 cents, 80 cents for the year. That's steady. There's been no volatility in the dividends. And then our dividend yield is 3.20%. It looks high for semiconductors, but falls average with the tech sector at 3.2%. So our overall recommendation, we recommend to buy Xperi. Its current price is $24.91 with the dividend yield at 3.2%. We would hold it for a minimum of a year. We came to that analysis based off of analyst recommendations and their DCF, the DCF models. We didn't have time to make a DCF model, but we're going off of the analyst recommendations, and then we're going to sell price at $37.
All right, and then that's our pitch on Xperi. Any questions?
So, okay, but I think you answered it, I'm gonna ask you anyway. If you had more time, because I know that you're all time constrained, Professor Sweets pointed that out, and you did a lot of analysis, so what would you have, if you had some more time, where would you have spent it? It sounds like you would have spent it on valuation modeling and DCF, but I just want to confirm that, or what else you would have spent the time on.
I would have started spending more time on the PE ratio.
Okay.
I was having a little hard time with that, and we saw a negative earnings per share, so it brought us into the thousands with the $24 price, and that didn't seem right. And then also we saw a negative, so it didn't seem right. So I kind of like to pinpoint on that a little more and reach a conclusion that I felt comfortable with.
Okay.
Yeah, because the P ratio, it seemed like they had a negative earnings per share previously, and then we saw inconsistency across multiple platforms saying negative compared to like possibly 1 cent, and then so that was giving us such an extreme PE ratio, so that wasn't a good evaluation of the company, and we would have liked to see some consistency with the PE ratio.
Also, all my numbers were taken from the 10K. So if we went on to Bloomberg and different places, we saw almost different numbers or close, so we knew where our range was, and that's how I kind of approached that situation.
Okay.
And then we saw something else that was really interesting was like all throughout 2018, they had a litigation with Samsung. They finally settled it in December. So that was some litigation expenses, I believe $26 million that they spent in 2018. So that contributed to our view of it being undervalued in December. And then for that drop in December up until now, an average incline of the tech sector was around 22% since it had been increasing throughout 2019, but Xperi was down at 12.70 and now it's at 24.93. So it's doubled in value since then. So we see that as a lot of potential for 2019, and hopefully it'll continue going with that momentum.
Okay.
Question? All right, good job, guys.
All right, thank you.
Thank you.